Yale, MIT, and NYU just got nailed. Excessive fee lawsuit in DC one. And it's a shift because everything up to this point has been on the side. This is the first time that an excessive fee lawsuit brought on a 403B plant.
Should you unlock the phone book? Probably.
Sure. Yeah. Thank you.
Hey Mike, how are you?
Can't see a thing.
No. George is here. No, your meetings today. Oh, what conflict? That one.
Hey, how are you?
June 30th.
Morning. Good. How are you, Danny? Hey, Stephanie, it's Dan. Listen, I just got a message that there's no power in the Flint office, so if you can spread the word. Consumers ETA is able to talk, but they think
Good morning, how are you?
I know you're on vacation. I'm on vacation.
How's retirement treating you?
If you need me, call my personal cell.
I'm jealous. I'm very jealous.
What's up, Mayor?
Doing good, man. Living a dream. You got power out at work?
The Flint office is on.
Oh, okay.
Hi, I'm Brian Green.
Brian.
I work with George.
Dave Coulter. Very nice to meet you, sir. Let's see if I got a... Oh, wait, I might have a card here. Here you go. I'll give you one.
Brian Green.
Here you go, Brian.
Casey, pleasure to meet you.
Yeah, good to meet you.
Brian Green.
Good morning.
Good morning. How are you?
Fine. How about you?
Good. You don't happen to have copies of the agenda, do you? No. Just yours? That's okay. Yeah, if we could maybe share, because I never bring copies.
Hi, Brian Green. I work with George.
Right. Yeah.
He's lost weight.
Huh?
George looks like he's lost weight.
He does, actually.
Did you lose weight? You look good. Did you lose weight? You look good.
No.
Well, the
Slimming on you.
I'm just saying you look good, man.
All right, now pull up the packet. Ooh.
So, did you talk to Melanie about the rat meeting?
Oh, yeah. Grab that paper.
Oh, I haven't had it to grab.
Whenever you're ready.
Lots of drama.
I haven't had one on April today.
Yeah. Yep. Yes. Short answer, yes. We'll talk.
All right, Madam Deputy Clerk, call to order today's meeting of the joint meeting Employees Retirement System Board of Trustees and Police and Fire Retirement System Board of
Hey,
Trustees,
Jenny.
Thursday, August 11, 2016. Roll call, please.
Mayor Coulter?
Here.
City Manager Lynch? Here. Chair Martin?
I'm the
Here.
mics today.
Let's see. Trustee Bishop?
Here.
Trustee Meade?
Here.
Chair O'Loughlin?
Here. Thank you. The first item of business is approval of the police and fire pension contributions and interest statements for the fiscal years ending 2014, 15, and 16.
Do you guys do it?
Yes.
If I can make it there. Good morning. What you have before you for this is, I believe, annually. However, we interestingly had a change in staffing to our department and recently became aware that what you have are years 14 of the pension interest accruals that then will be, if approved by the board, communicated to all the participants in the board or in the system regarding current amounts and interest earnings.
Any questions on the issue? Everybody familiar with what this is?
Yeah.
Is there a motion to accept?
I would move to accept.
Support.
All right. Ready to vote?
You do by name call?
Yes.
Yeah.
Or we just do the other way, whichever is fast. Good.
Name,
Names or
whatever you like.
whatever's faster.
Then you just do a motion or
Yeah.
all in favor?
Aye.
Aye. Opposed, same sign.
All right, thank you. And the second item, approval request from Jacob Ladson for the withdrawal of his pension contributions and related interest from police and fire pension system.
Okay. This is a pretty standard request. Jacob Latson left the fire department and in June of 2016 made written requests to withdraw his contributions and interest from the pension system. So this is just a formal request to pay those funds to Mr. Latson, meant the transaction on the record.
I move that we approve the request of Jacob Laston to withdraw the pension contributions and related interest.
Ready to vote?
You want a word vote?
Yes.
Okay. Mayor Coulter?
Yes.
City Manager Lynch? Chair Martin?
Yes.
Trustee Pesha?
Yes.
Trustee Meade?
Yep.
Chair O'Loughlin?
Yes. All right. All right, and now we're going to discuss a policy regarding pension estimates submitted by HR. Again.
So my last item, we recently, over the last couple of years, have received quite a few requests for by members of the pension system for estimates of their pension values. And so we found it necessary, and I believe there was some discussion at the last board meeting as it related to that process, what that looks like, and sort of how we do that best to make sure that not only are our efficiencies being handled accordingly, but that the staff get their estimates as they as reasonably desired. So we did some research into other communities who manage pension funds. And put that together into a policy, a draft policy that we think is reasonable and that manages both of those issues fairly well. That being said, there is a lot of time and effort on our staff's part to compile and provide the initial estimate as it relates to the straight pension. From that point, that particular estimate is then turned over to Gabriel Roeder, who runs an actuarial calculation on those numbers. That piece of it is the part that is very costly, and Gabriel Roeder has some caps on the number of estimates that can be requested each fiscal year through our policy. Anything that is requested above and beyond that is then charged back to the pension fund for those estimates. So what we're trying to do is provide reasonable estimates for those who are approaching retirement. So in essence, our suggestion is that if a member is within 3 years of retirement, they have the ability to request one estimate that would be complete with an actuarial evaluation of their account. And then they would also get the Excel workup of their straight life pension. From that point, they can use those numbers going forward to plug in any future changes and determine any changes a year later, 2 years later, by simply putting in their payroll data that they have available to them at all times.
Can you clarify for me?
Sure.
Because it seems unreasonable for us, unless I'm misunderstanding you, to say you can't get an estimate until you're 3 years out. For retirement planning, that doesn't seem quite reasonable.
Well, to have an actuarial person, so the pension actual FAC is calculated on the best 2 of the last 10 years of service. But if somebody is not even anywhere near eligible to retire, then it really isn't a valuable estimate because so many things could change between the time that they, are working in.
Yeah, no, agreed. But I can today. I'm unfortunately something like 20 frickin' years from retirement. But I can still get an estimate from my retirement planning of what my pension is going to be today. And so I know how much I have to contribute to my 401k or other assets in order to be prepared in 20 years.
Sure.
Assuming that my salary goes on a reasonable trajectory, et cetera, et cetera, et cetera.
Right, and like I said, the straight life part of it, so the baseline for the pension evaluation can be done in-house and turned over to the employee where they have those.
So we can do it without the actuarial.
Correct. The actuarial evaluation, what that does, or calculation, is it gives the options for 100% survivorship, 50%, and if they want a 10-year certain option, but they get a really about estimate of their straight life pension amount with what we can provide in-house. What gets very cumbersome, time-consuming, and expensive is when we're doing multiple ones within one plan year or multiple ones for one particular person, either far out of retirement eligibility, so then you're running them multiple times, or we exceed our annual limit that Gabriel Roeder has, which happened this year. It actually ended up costing the city or the pension fund $2,500. We got invoiced for those. So some of them is just the cost of doing business. But what basically the policy is saying is you can get one, and that is way reasonable, and we will absolutely provide that so long as the person requests it in writing. And if they want an additional run, then they will assume the cost. We will process, but the actual member will pay for that going forward. So we're not.
One a year or one lifetime?
Well, the straight life we could provide, that can be modified at any time. The actuarial would be one within the 3 years that they're eligible, and then a final would be run at the time that they retire at no charge. That's operating.
Okay, so I'm just giving them the spreadsheet.
Yep, so it would have the estimate with all of their FAC calculated for them so they can see for the last X number of years what all their pay rates were and how that's calculated. And then basically they just modify each year. So if in 16 they receive one, at the end of this year they can plug in their numbers or in 15, they can plug in 16 and see where that matches if that changes their FAC.
Does GRS charge anything for that?
That is done in-house, so Gabriel Roeder does not charge for that. What Gabriel Roeder charges for is the actuarial calculation.
How labor intensive is that for you guys?
It's fairly laborious. Once we've run one for that particular member going back, I wouldn't say it's as laborious, but prior to 2011, all of our internal payroll documents are paper and pencil books, and so it can get pretty labor intensive to every pay code, every payroll, go through and document all of that. So we've been working to streamline that, but yeah.
Well, here's what I was thinking, just in looking over this. If they're requesting a full actuarial calculation within 3 years of retirement, and then a final one, why not make the straight life estimate available before that?
It is.
And not,
It could be.
Saying don't limit to within 3 years, you know what I mean? So that they could request it earlier.
You can get the straight life at any time.
Yeah, I mean, if someone came up and said, sure.
Well, it says, under this it says, if we're there within 3 years of retirement eligibility.
Oh.
That's the third bullet point on that.
Right. So if that is what the board is interested in, we could do that. What we are trying to prevent is running those every year for when the employee themselves they have all that data online now through our payroll system. Yeah. So modifications of that can be done at any time on their own. So providing that initial one, I don't see that as being an issue. Most of the members, to be quite honest, a lot of them have gotten it in the last couple of years anyway.
Maybe we could make that available before they're within 3 years.
Sure.
Yeah, that would make me feel more comfortable.
Okay.
Thank you.
I think we're just talking about the Gabriel Road or one,
Sure.
Well,
but everything
right.
else is thinking,
Well, it says on this
oh,
side.
does it?
Yeah, the
Yeah,
policy.
they were married just because that was part of that initial, but that's fine.
How many actuary requests are you allowed through Gabriel Road a year without being charged?
This year, we were allowed 3, and Marnie and I had a conversation. Marnie went back to Gabriel Roeder and explained that with the membership we have and the number that we've been running, is there any way we could talk about increasing that number? And we did just get confirmation the day before yesterday they would be willing to go to 6, so they're sort of combining the employees, the amount that we could run under the employee system and the amount under police and fire, and saying in totality they would run 6 a year before they would charge us going forward.
So do we need a motion to accept the policy?
Yes, sir.
Yes, I have a couple comments, if I may, on policy. First, I think we should be recognizing several places in the policy refers to the city's actuary or the city's representative, designated representative, and it's really the pension board's actuary, right? And the pension board's designated representative. So I would just suggest that those references refer rather to the city, to the pension board, or the retirement system. And then the one other thing on that third bullet point, I guess I just want to make sure, because the board's adopting this as policy, that we're clear that the policy will be amended, or I think the board is suggesting it be amended with the third bullet point, that members have the ability to request one straight life estimate that is not actuarially calculated at any time during their employment. But I think you may want to put a caveat to that. However, no more than X number, a year or 2 years or something. You do run into, sometimes you do run into these employees who
Every year, want to see it again.
every year, and I have to tell you, in the DB plan,
Sometimes you need the
an
encouragement.
estimate of benefit
Sometimes you need the encouragement.
that I'm going to get, I can benefit 10 years from now, and I come back and now it's 9 years from now, isn't going to change every year, and you know, that calculation can be easily performed. If at any point in time you members really want more information on this, there is language in we see them very often in employee handbooks. They give the employees the ability to really, it's a formula, plug in the numbers that they can do that estimate themselves as well. But I do suggest that you be very clear on what your amendment is to this third bullet point.
Well, this is an Excel spreadsheet that they can, you know, they can keep, and they can look at the next year and put in the numbers. Okay.
All the formulas are built in. Yeah.
So I propose that we scratch that if they are within 3 years of retirement eligibility from the third bullet point. That's just for the straight line estimate.
I would make the recommendation that we do put some kind of cap on that, because absent the cap, then, yeah, we'll be hit up every year. Right, but they could do one a year, one a month.
Whatever, 2 years.
Yeah.
Well, you're saying that they can take that spreadsheet and use it the next year. He's saying that it's not going to change much from year to year. So what's the point of them? You're saying that this is a lot of work for you to do this every time. If they want it, if we have employees that are requesting it every year for no unnecessarily.
Right. What I would face is probably a grievance for not providing it. I would be more comfortable from
So
it.
if we keep the language as is, spreadsheet, they can check their benefits. I mean, it's an estimate anyway, right?
So just say.
Yes.
Yeah, just say 1, and then keep it as is, but scratch the if they're within 3 years of
Who
retirement
represents it?
from that third bullet point.
Negative what? So what is it?
Right.
I've done one every 5 years or something. but-
Okay.
That's, they've got
You're
their
going to
benefits.
request your pension.
estimate
You're
calculated.
going to request your pension.
Okay.
That-
Just because I'd like to. The only thing I would suggest is that you say you can do one, but you can do it flatter than 3 years. And the reason I say that is sometimes circumstances really do change. You change your multiplier, you come up with a different compensation structure and things of that nature. And so you know, it makes sense rather than somebody someday, because someday will not all be here, hopefully, we'll be retired and sitting on the beach somewhere. Someone else will be administering this policy. And they may say, oh no, you got one 10 years ago, and that's it, you're going to have to pay for this estimate. So I think, you know, it should be pretty clear. You can get one free estimate every 3 years, I think is probably plenty. I heard someone say 2 years, or every 4 years, or even every 5 years, but I think, you know, it usually gets stretched out. That's all.
Yeah, I mean, they can put all the data in themselves. So, I mean, and if someone ever needed assistance, we would walk them through that, but yeah.
So are you, again, just getting in one every 3 years, or?
Members have the ability to request one straight line estimate. No, that's not actually every 3 years.
Just change it if they are
Once
within
every 2 years.
Just change it if they are within to once every.
Once they have the data, we can just manipulate it.
Right.
It won't be as bad. Okay.
Are we clear on that?
Yep.
The wording? And we also need to change the language. As our attorney mentioned.
At the bottom of the first page where it says payment shall be made to the city after receiving current cost from the retirement system. Further down the second page, members can expect 1 month turnaround time to obtain either the actuarial calculation estimate performed by the pension plans or retirement systems actuary, not the city. And then made in writing to the pension board's designated representative. I think this will help employees realize that it's not city driven as much as it's.
Also on the second page, that last bullet point, we should remove the one straight line estimate and just say there is no fee to the member for obtaining the straight line estimate.
Right.
Just clarify one more time, the straight line comes from Any other concerns, or did any of us have?
Do you need a motion? I move that we accept the policy as amended.
Or
Mayor Coulter?
Yes.
Lynch? Yes. Martin?
Yes.
Let's see, Pesha?
Yes.
Mead?
yes.
O'Loughlin?
Yes. Thank you.
Thank you.
All right. Next will be the second quarter 2016 portfolio as submitted by Loomis and Sales. Would you like to combine them? Mr.
Yes.
Shelby?
Yes.
Yes.
All right. Morning.
Morning.
David Sowerby, Portfolio Manager at Loomis Sales. Just by way of very brief background, you've obviously been a long-term client, I think 1969. And I've been your primary portfolio manager for over 15 years. So what you know the usual presentation is, very brief. You can ask a lot of questions. You have a pretty full agenda today. And all I'm going to do in 10 minutes or less is simply discuss brief views on the market, some specifics on the individual portfolios that we manage for you. First, to the markets. Mid-August, turning out to be a much better year than the first 6 weeks gave us. It's almost two different markets in 2016, but that's why you're a long-term investor. It's easy to say that. Very often it's harder to practice it. I remember one time reading a quote where somebody said, I'm a 5-year investor, but 1 year at a time. It's the long-term and the discipline that gets you to the type of peer group rankings that you've achieved. So in light of that, stocks on average are up better than 7% as we move into mid-August. that February 11th, not to get too precise or too granular, was the inflection point this year. Nobody rang a bell and said, get back in the market. The most important measure around early February was there was a lot of mistrust in the market. And that's important today because back in early February, more than 80% of individual investors would have said that they were either bearish or neutral. And that's usually, from a contrarian perspective, a sign that it's good not to capitulate, and if anything, to be a little bit more of a buyer or risk taker. And I only cite that number because it comes out every Thursday morning, and today, 70% of individual investors say that they're either neutral or bearish. And that actually, ironically, can be a good thing because we know markets go higher on the famous quote, markets go higher on mistrust, and they fizzle out or they die on euphoria or bliss. So the fact that stocks have rallied quite well since early February, when sentiment was very bearish or neutral, I'm encouraged that in this rally that is 6 months, that you've seen small cap stocks lead the way, that you've seen value stocks lead the way, and you've seen high yield bonds do quite well. And in particular, small cap stocks and high yield bonds continuing to do, that gives me a little more that this rally or seen since early February still has some legs left in it, along with my view that sentiment is more mistrusting than euphoric. And that ultimately bodes well, I think, as you start to look forward, not simply for the remainder of the year and the too often asked question of how's this election going to affect the market, because you know for your pension fund it goes well beyond whoever wins the November election. It's really about what am I paying for security, what kind of cash flow is it generating, and what's its long-term view on its ability to generate shareholder value. So I think that sets you up for respectable, with a capital R, type capital market returns in the stock market and in the high-yield bond market, and that needs to, I think, really row the boat hard because of the low yields that exist in instruments such as a 10-year U.S. Treasury, which yields roughly 1.5%. You're not going to pay pension fund assets on a 1.5% yield, especially if you back away inflation. So moving forward and quickly to the portfolio, I'll highlight performance. I know Bogdan has a very ample and sufficient, excellent report to give to you today. If I just quickly run through the individual pieces of the portfolio, I'd sum it up this way in baseball terms, year to date, let's call it 2 for 3. Your high income bond fund, which you're more recent to in the past few years, is up into August over 14%. I said high yield has done quite well. That's important because high yield did not have a good year. High yield bonds did not have a good year in 2015. But high yield has come back and we've outperformed, and that's a good thing. And at the end of the day, we want to be good bond pickers. We want to be good stock pickers. You've heard me joke too many times. Nobody asks me for a bond tip at the Dream Cruise party, right? But we want to be good bond pickers too, and your high yield bond fund has done quite well year to date. Let's call that in Detroit terms 92 or better octane. Your 87 octane fixed income portfolio is intermediate maturity in nature. It too has outperformed on a year-to-date basis. But what they both do, and I think this is the well design of your consultant, is you get a little bit of 92 octane and you get a little bit of 87 octane, and they blend together in their allocation because you don't want all high yield for when you need that rainy day in the markets. Your large cap value portfolio, as I've sent out some communication to you year to date, has lagged. That's not commensurate with the long-term returns. It's that you've been a long-term client because you have a long runway with us. And if you look over the last 10 to 15 years, your large cap value portfolio has done quite well. It's ranked in the top quartile in batting average, risk-adjusted returns, and absolute returns. That's important because this is a long-term effort. And I put one page in there to be concise. It's on page 4, where I've shown you that it's good because you've had a long runway and you've seen those solid long-term results. But equally important is when we underperform in the short term, we have a good track record of getting it back. So briefly, why have we underperformed? Very candidly, stock selection in financials, a little bit in consumer discretionary, has lagged. We have been more mistrusting in some of the more stable consumer staple stocks. The market has had a healthier appetite for that. I think that is giving way to high-priced valuations in a sector like that. What's going to define your portfolio over the long term is stocks that generate above average free cash flow, have a superior free cash flow yield, generate a higher return on equity, and we're trying to buy them at a discount to their intrinsic value at about 70 cents on the dollar. The good news today is when we do an intrinsic value calculation on a portfolio, it's selling at an even deeper discount to that, more like 60 to 62 cents on the dollar. And I'm also encouraged, as I said at the start, that after a pretty good run over the last 3 years to growth stocks like the Googles and the Facebooks, you've seen the market in early February rotate back to value. Now, always beware of the value manager who walks in the door and says, it's a great time to be a value investor. It works over the long term. It doesn't work in every single year, but in 25 to 30 years of market history or longer, the manager who pays heed to the valuation to pay for a security does quite well. And I think, as unbiased as I could be, I think the next 2 to 3 year run bodes well for the value type investor after a big run to growth in 2015 and the prior 3 years. So that really sums it up from the market perspective. I wanted to hit the portfolios we manage for you, but really address, it's easy to talk about what's outperforming in the near term. I think it's more important to address what's lagged relative to good long-term results, why it's lagged, and again, our ability, in short periods when we do lag, how we recover because we stay disciplined. We don't chase what's working. We buy what we have conviction in. So I can take any questions from the board or from Bogdan.
No? Good.
I'm good.
Guys have any questions?
I do, Dave. So the media seems to understand that stock prices are at all-time highs, interest rates are at all-time lows, but as usual, media doesn't look at today or tomorrow. They only talk about what happened in the past 10 minutes.
Lunch to date.
Yeah. So from your perspective as a longer-term investor and working with the board for a long time, the only thing we haven't seen before is this record low extended period of interest rates. And for whatever reason, the media seems definitely afraid of trying to tackle that. I guess maybe so, because this is history being made. This has never happened in the history of the capital markets, where you have so many countries with negative interest rates, and the U.S. has fairly positive interest rates after inflation. What are your thoughts in terms of oil strategy relative to how much in stocks, how much in bonds, how much in cash over the next 1 to 3 years, given today's scenario?
Sure, and brief answers are best. In descending order, as much as out the next 3 years, and that's certainly better between now and the election. Stocks look more compelling than bonds for a number of reasons. So I would want to modestly overweight stocks, especially that number I cited, that the yield in most pockets of the bond market is not very appealing relative to your actuarial returns. I'm a believer that when you try to make an assessment on the stock market, good luck trying to predict a 10% correction. They happen once a year. By the time you recognize it, it's halfway over. The 20% or 25% down bear market is what keeps you awake at night. And as much as you can make a call on that, and it's hazardous, it has still a lower probability. The type of things that give you bear markets are valuations that are well overpriced, policy mistakes, too much leverage, and it's really hard to see that. So if I had to put a hard number on it, I'd say the next 2 to 3 years, let's say 3 years, that stocks compound between 6 and 6.5%. That's better than what most elements of the bond market are going to give you. And if you take the right direction, I think you can maybe get better than that. And I finally say valuation is about a C or a C plus. If you value companies on a cash flow or free cash flow basis, in particular instead of earnings per share. And that's better than the CNBC second soundbite we get.
Wait, are you a radio soundbite? I'm sorry.
Yeah, those I'm sure they passed it out to you. Brian gave me a paper about 2 months ago that is worth reading, this IMF paper, and I've gotten a lot of mileage on it, but he was the guy who gave it to me. It was really good reading for anybody who sits on your side and our side of the for running money or being a trustee. It's an excellent paper that really talks about the long term versus some boards who think too short term, and your success has been because you have thought long term. Thank you.
Thanks. So moved.
Support.
You can do it all in favor, I think.
Oh, do I get to say?
That's you.
Okay. All in favor?
Aye.
Opposed? All right, motion carries.
Thank you. The next item is the second quarter 2016 investment performance review as submitted by the Bogdan Group.
Good morning. Good to see everyone. I'll go through the employee retirement system report first, followed by the police and fire, if that's okay. And if I might ask the board to indulge you for just a few minutes, I have a couple of my new colleagues here that I'd like to introduce, and I know our CEO, Mike Welker, would like to give you a warm welcome to the organization as well. But without further ado on the employee retirement report, just want to assure you that despite the volume of the report, the contents are the same, organized a little bit differently. There is more detail if you like to dig into the weeds of investment returns and investment risk. It's certainly there for you. But in respect for your time, as you always try to do, I'm going to highlight 2 pages for you. And the first page that I'd like to highlight is page 22 of the report. And it says comparative performance trailing returns in the upper right-hand corner. In the package, it's page 117, if that helps. If you're using PDF, mine says 117 in the upper left corner. Okay. So as David prefaced everything, we thought the world was falling apart on the afternoon of June 23rd, right after the UK voted to withdraw from the Eurozone, and then things tumbled into the 24th, and then, of course, we all know what happened. Things went straight up. Stock and bond prices recovered very nicely, and ended up with a very strong quarter for stocks and bonds. The commercial real estate market was also unaffected by that short-term event over across the pond there. So in the first 6 months, we had a seemingly free-falling U.S. international stock market through February 11th. Things rebounded. Second quarter, June 23rd, came and went. Good quarter. And as I just mentioned with David, there's been a lot of records set lately for U.S. equity indices. And as we know from the past, sooner or later, prices do return to equilibrium. They will correct. Although, having said that, not everything in the stock market is overpriced today. And there are, of course, lots of different valuations. And I only bring that up one last time simply to say that the fact that indices are hitting records should not be an immediate alarm or concern to us because there are stocks in those indices that are trading for less value than they were a year ago. And as you know, the indices are full of many different stocks, and not everything is trading at a record price. So, a word of caution is always in order when we listen to whether you listen daily or weekly to the media, financial media. The results for the employee retirement system for the quarter ending June 30th, 4.02%. Very strong 3-month rate of return. That was actually a little bit ahead of the policy index, which what we would have achieved if all the managers had done their job, but some of them did a better job. So the policy index was up 3.86. And when I look at how the retirement system result compares to the peers, that is other public retirement plan systems across the U.S., you get the gold star this quarter, number 1. Rarefied, year-to-date 6 months, we fell a little bit. We're only ranked second. But 5.8% for 6 months is very strong. We'll hope that we can sustain that rate through the end of the year. The trailing 12 months ending June 30th, 5.25%. That was a little bit behind the policy index that was up 7.2%. But we had some portfolios did very well. We had some that missed their benchmark. So the overall result was 5.25%. Now, when I look across the U.S. and I look at how other public plans did in the last 12 months, you're in rarefied territory again, in a significant margin. And that said, I know what we're all thinking about. In the general plan, we're trying to hit 7% consistently. On the other hand, we can't do anything about what the stock and the bond markets are giving us. We're all price takers at the end of the day, and in this case, there hasn't been a lot to be taken advantage of for the past 12 months, as we've discussed. The longer-term results are similarly very, very good. If you look at the 3, 5, 7, 10, and since inception, going back to 1990, the average annual return is 8.41%. And it's no secret, but as we've talked about in the past, this is one of the reasons why this retirement system has such an extraordinary level of funding and financial security. Okay. All right. The only other page I'd like to highlight is go up to page 12. Which is 109 in the package. So good quarter. The equity index strategy, the high income fund were key contributors to outperformance. All of the managers are following the investment guidelines. That's always good to be able to report. And then the last item is the transition from asset strategies to the Bogdan officially on July 1st. So that concludes all my formal comments. Be happy to answer any questions. Any thoughts? Okay. Well, that includes the employees' retirement system report. You want to go to the police and fire? Okay. I want to say thank you for your patience. This is the first time I've tried to use the tablet entirely for the report. So I know we're all trying to go to the digital age, and I'm trying very quickly to get there. Okay, so similarly on page 22 of the police and fire report.
I think it's 20.
20? Okay, thank you. As you could see, the results for the police and fire retirement system were also very good. 3.74% gross and or before fees rate of return, and that was actually a little bit better than the policy index. If you're curious why the police and fire result was a little larger and a little better, it's because we still have a lot more liabilities to address. We're not as well funded as the general. We have a little more risk exposure to stocks to get that hopefully measure of long-term growth from the equity exposure. So we're the plan is doing very well this year. The 6-month rate of return up 5.77, the 12-month rate of return up 5.34. So on well, I should say as I go down the page, let's say across the page, down the page, the individual portfolios, you could see they're all hitting the benchmarks in the short term, and the long-term results are equally good. The concluding comments, which are back on page 11. 12, I'm sorry, or page 148. Again, the key drivers of the retirement plan outperformance owing to the high income fund, which is a nice name for junk bonds, and the low volatility equity index fund, which outperformed the broad U.S. stock market by a very significant margin over the last several years. All is well in terms of managers following guidelines. Another quick comment, looking at the allocation across the different investments for the retirement system, at the end of the quarter we're very close to the targets, so we don't have to worry about rebalancing. That's really all I had to say today. It's always easy to deliver good news. But I'll pause and be happy to answer any questions. Thoughts, concerns?
I had a quick question. Back to page 20. Just looking at the international policy index on the short term and the near short term, should we have concerns about that as far as the 1 year and the 3 year? Not ours, not development particularly, but just in the fact that those markets are really volatile, and that keeping it wide, but it's something we should be concerned about.
Well, just good question, Mike. I often ask myself that too, because not only recently, but for quite a long time, the international equity markets in general have lagged the U.S. Significantly. And that's just the developed countries. So Canada, Australia, New Zealand, Western Europe, for example. Then you have the emerging economies, Eastern Europe, South American countries, Mexico, South Korea, those sorts of countries that are still have China, rapidly growing, developing economies, nowhere near like China, U.S., Japan, or Western Europe. The thesis is not broken, although it's challenged frequently. The thesis is that these countries that have developing and faster growing economies should, in theory, provide better long-term return opportunities for equity investors. Okay? It's that simple. There's nothing more to it. Companies in the U.S. that serve the consumers and the businesses in those countries should also, in theory, have the opportunity to grow their earnings faster and provide a better rate of return to equity investors. So that's the textbook definition of why we invest in international. There was one other piece that doesn't really apply anymore, and that had to do with diversification. But in today's global economy that's connected literally 24/7, the math doesn't hold up anymore for being invested in Europe just for the sake of not being less. Okay, there's too much connection these days. So when we look at the long-term benefits, it comes down to where we think we can grow investments, grow assets at the best risk-adjusted opportunity. And we're in a period now where you're not getting that from broad international investing. So that's why we hired Vontobel, amongst many others, and they'll look at the global landscape and they'll say, well, I got X number of countries outside the U.S. that are in the developed status, and then I've got all of these emerging economies to invest in. And they take a look at where they think the best economic opportunities are for companies to do business, and then they look at which companies in those countries they think are going to grow their earnings the fastest. And so we take that active approach and we rely on the manager to uncover those opportunities. And to sum it all up, the thesis is not broken. We still believe that there is opportunity for superior risk-adjusted returns in the international arena, as long as we have our money with the right manager. And Vontobel's doing a reasonably good job, as you mentioned. They have been able to outperform the broad market indices over time. And so hopefully that addressed the question. You going to take all your money out now? Any other thoughts or questions?
Doesn't appear to be. Is there a motion to accept the report?
So moved.
Support?
Name call?
Sure.
Mayor Coulter?
Yes.
Manager Lynch? Yes. Martin?
Yes.
Pesha?
Yes.
Mead?
Yes.
Alon?
Yes. Thank you.
Okay.
Oh, you want to add something else?
If I may, is this a good time? Sure. I'd like to introduce my colleagues from the Bogdan Group. Mike Welker is our CEO. He's from in Orlando in search of warmer weather, which he's found this week. And Brian Green, by way of introduction to Brian.
Thank you.
Brian and another consultant and myself are in Southfield, 12 Mile and Telegraph, Southfield office for the Bogdan Group. So we're still here. We're still focused on the Michigan market. I'll turn it over to Mike, and he'll talk to you a little bit about the company.
George, is that a change in physical location for you?
It is. I moved all the way from 10 Mile and Grand River. Well, yeah, in Novi.
Yeah. Loves MDOT right now for all of the
Right.
Construction on
A
275.
lot of good stuff.
Well, thank you. I will not be long. I'll keep with the theme of today and be brief and succinct. What Brian handed out was just a brief informational packet about the combined firms. So as George told you in the second quarter, our two organizations came together on July 1st. So this just gives you a little summary of the firm, the combined firm. First page is a little bit more of our mission, our values, the services we provide, which are spot on to what ASPS did. So that's why, this worked. The back page talks about, I think, the exciting part of this deal, which is the additional infrastructure and resources that we're going to be able to provide the consulting team, George and Brian, as we work together going forward to, hopefully continue to add great value to the portfolio. And the numbers have been good, but that's the idea here. So I just wanted to say one thing, which is thank you for the opportunity to continue working and that I Good. Sorry about with me from the south.
Yeah.
When I leave tomorrow, hopefully I'll take it back with me.
I'm going to leave you with two things, just by way of introduction. I'm Brian Green. I'm actually local. I laugh. I think I had for those that are even closer, I'm at 12 in Woodward. So my commute to the meeting today was kind of nice. I texted my wife when I got here and I said, just like in January, I got to the meeting before my car warmed up. I got to the meeting before my car actually cooled off. So I've actually been here for the last 16 years, working for Morgan Stanley for 14 of the last 16, all on the public fund side, and actually joined Bogdan back in September. I've known George for a number of years. We actually talked about working together for off and on for about the last 4 or 5 years. But I wanted to leave you, the numbers are fantastic. Leave you with one thing, right? It's the Little League World Series right now. I don't know if there's any baseball fans, and I got this alert on my phone this morning. If you go on just ESPN.com and about a third of the way down the page, there's a picture of a 12-year-old kid with the biggest smile on his face you could possibly imagine. And it was Rhode Island versus someone else, I don't know who the other team was. And their tournament's double elimination. So they were in their, the final match. Like the loser was going to be eliminated. 2 outs, bottom of the 6th, right, in Little League 6 innings, bases loaded, and the kid hits a grand slam home run to win. Like that pure, absolute joy moment from a childhood standpoint. So I pulled it up this morning when I was sitting in the parking lot, and it's such a cool picture. I had to pass it along. Like if you're having a bad day and want to have a better day, like just take a look at that picture, and the look on the kid's face is priceless.
At 12.
Mike, so we'll continue to work with George, correct?
Correct. Yeah.
And how long have you been with Bogdan?
Since 2001. The company was formed in September of 2000. So I've been there pretty much since the beginning.
And what's your
background? How far do we go back? Born and
Not
raised.
Little League.
Little League. Never did a walk-off grand slam. Background was raised in northern Indiana, but moved down to Central Florida to do a childhood dream of playing college basketball for Division II school. So anyways, I did that. And got my undergrad and MBA at a school called Rollins, worked on the money management side for a few years, worked on Wall Street on the floor, so I had some experience there, and then met Joe Bogdan, the founding principal of the Bogdan Group, when I was doing what Dave does as a portfolio manager, talking about client portfolios, and then Joe recruited me over to the consulting side in 2001. So been with the firm ever since. So background has always been in finance, been on the asset management side, and then on the consulting side. So I've been doing this since 2001.
And how many people does Bogdan have in Michigan?
Bogdan has 71 people.
How many in Michigan?
I'm sorry, Michigan, 3. Yeah, it has Brian, George, and Chris.
So what are the other locations?
The headquarters is in Orlando. Then we have an office in Chicago, Pittsburgh, one in Tulsa, one in Detroit, and that's it. And have an outpost in Milwaukee and Memphis.
How many clients like us, like this board?
Like this board? Over 325 public funds around the country. So public funds are very, very important to us. So
But you're a private company, correct?
We are a private company, absolutely, yeah.
Is the public funds the bulk of your business?
Yes, it is. It's about just over 50% of our plan types are public funds.
Any other questions?
Thanks for coming up.
Thank you guys very much.
Thank you.
You should have been here next weekend. It's Dream Cruise.
That's what I heard. I mean, yeah. Get some stock tips, or maybe some bond tips, right, David? We can talk about bonds. Thank you again very much. Appreciate it.
You always call somebody on his hat. I'm not sure who it is.
Let me approve the minutes from the last May.
I move to approve the minutes of the previous May meeting.
Support.
Mayor Coulter.
Yes.
Lynch. Martin.
Yes.
Pesha.
Yes.
Mead.
Yes.
O'Loughlin.
Yes. Thank you. Is there any new business for the board? Anybody? All right. Meeting's adjourned. Thank you.
All right.
Yeah.